Joining us now is BlackRock's Michael Fredericks, and I'm pleased to say Adam Parker of Trivariate Research joins us too. Adam, let's start with you. Your reaction just to the conversation, the big debate over inflation in this market in the last 24 hours.
What we do, and good morning, good to see you. What we do at Trivariate Research is we focus on the stock part of it and stay away from the economic part of it. And what I mean by that is we measure the statistically significant relationships between industries and the slope and level of the curve. And we think there's three important implications. One, we think you can buy healthcare services and buy technology hardware. Historically, they had a relationship, and the stocks haven't really beaten the market year to date. Two, we think you pair trade the banks. Even though banks do have sensitivity, there's so many banks where their multiple, the so-called price to tangible book, has expanded a ton since last August lows in the 10-year yield. But the book value itself, the tangible book, hasn't grown very much. So we think you have to be more cautious there. And then the third implication is to sell utilities where they have very consistently had a statistically significant relationship to slope and level of the curve, and it's a negative one. So I think that's the real thing I focus on is the stock implication of it, because that I can measure analytically.
That's what I want to focus on, Adam. I'll come back to the banks call in just a moment. I want Michael to respond to that question too. Michael, your response, your reaction more recently to the incoming data.
Yeah, it's not exactly going to script, is it? It's between the weak employment reports, and then we had that pretty shocking headline CPI print yesterday. But I think if you kind of disentangle the more volatile components from the more stable components, it's a lot less dramatic, honestly. So we were just talking about hearing about the used car prices and the impact on airline fares, and some of those things can continue to go higher, like airline fares have the room to run. But if you look at the stable components, it was less dramatic. And I think that's part of the reason when you look at, say, 5-year break-evens, they popped 12 basis points on the release, and then throughout the day they drifted back down to where they closed up about 3.5%. But look, it's going to be a bit of a bumpy ride as the economy normalizes and we get more data points. And look, ultimately the Fed is going to start tapering and start raising rates. But it's the observations like we had the last couple of days suggest that it's not going to be linear and orderly as maybe the markets would like to see.
Got a 22 basis point trading range, make it 23 from where we are to the lows of Friday on a 10-year, Michael. Right now at 167, call it 168. We're at 146 last week on Friday. People have talked about this tight trading range, but it's been really volatile. Michael, what's your view on yields? And then I want to come back to Adam and talk about the bank sector. What is your view on yields just more generally from here?
Yeah, we think they're higher. We're still running the lowest levels of duration we've ever maintained in our strategies. So we think that the path of rates is higher, and that the distribution of outcomes is that there's a lot more scope for rates to move farther up and more quickly than for rates to move down. So that's how we're positioned. I think it's a real problem for more income-oriented investors. We run funds that are income-oriented for, generally speaking, older investors. And if you look at the Barclays Ag, most clients have a lot of exposure to investment-grade bonds. And if you just look at the Barclays Aggregate Index, you're down about 3% on the year. The yield on the ag is only about 1.5%. So it's going to take you 2 years of coupon to kind of claw back the hole you're in, even year to date. So there's not that many positive, real yielding assets out there.
Yep.
And I think this narrative is going to persist throughout the year, and the pressure on bond returns, especially investment grade and on treasuries, is likely going to continue.
Adam, I wanted to set up the rates conversation to come back to the banks call for obvious reasons. You're less constructive, relatively speaking. Can you plug in the rate story to that call? What does that look like?
Sure. I mean, look, I think there's a 6 to 12 month view, and then there's a longer term view, and I have to parse it out because like Michael said, I think everybody thinks rates are rising. The 10-year yield's rising here in the next 6 to 12 months. I haven't talked to anybody in the last week who thinks we're going much lower on the 10-year yield. So the challenge is how much to position forward in your equity portfolio and which stocks to go after, and that's what we're focused on. I have no idea what the interest rate environment is going to look like when we stop having massive fiscal stimuli and an incredibly accommodative monetary policy, and I don't think anybody does, and that's where the debate is. And I think the Fed is I know a lot of people like to criticize the Fed for being late, but I I've learned a couple things, and like the guys who are smart with 30 years of experience, I try not to say that they're the dumb ones. So maybe they're not behind, and maybe they're just waiting for better evidence of wage inflation and see what things impact the economy after all the stimuli. So that's the setup I think about. And in the 6 to 12 month view, look, the banks have had massive multiple expansion, and they really haven't improved their actual underlying corporate growth that much. So to me, I try to zig when everyone else is zagging a little bit. And I don't think as a basket, they're going to really outperform very much from here. I much prefer to go to places that have the relationship to the interest rates, but haven't performed as well.
Michael, your reaction to that?
I have a lot of sympathy for Adam's comments. We think if as rates move up, there's these really aspirational growth stocks. I think that's a legitimate headwind for those types of companies. We, in an income-oriented strategy like ours, we don't have a lot of exposure to that. But I do think there's a subset of technology in the growth universe where there's, incredible revenue growth, a lot of free cash flow generation, really impressive positive earnings revisions. And on those types of stocks, I think they can weather a move higher in interest rates. And we do have some exposure to those. We like writing covered calls on some of these names. You can earn a lot of income right now doing covered calls on that part of the market. But I think there's another part of the market that we think of as more quality and dividend growth oriented companies that were really out of favor last year. And they really started to perform very well this year. We've really been loading up on those types of markets. So we're running a lot of equity exposure in our portfolios right now. But the part of the market where we've really been adding the most has been in these kind of dividend growers. You can get yields in the low 2% range with a long history for many of these companies of growing that income stream in the future. That's pretty powerful when you look at, say, 1.5% yield on the ag. You get more in high quality dividend stocks.
Yep, Michael. Adam,
I agree.
Adam, you want final word?
No, I agree with that. I think a lot of this cycle rhymes the recovery from 2009 to 2010. And we're about 13, 14 months from the lows. And if you look at what worked then, it really is all about profitability and margin expansion. And that's why this inflation debate matters to me, because the companies that can beat numbers are still going to work, whether they're tech or not. So margin expansion and meeting the estimates, that's the number one thing investors should be focusing on 6 months out.